Okay, so how is money made? Like we know the government prints it, but why, when, and how? Well, your standard economics textbook probably has an answer to this, and spoiler alert, the answer is dead wrong. But we still have to talk about it. Okay, here's the textbook story. The Fed prints money, let's say $100. They then buy something from Joe with the $100, usually treasury bonds. Joe puts his money in a bank. The bank doesn't actually have to keep all of Joe's money stored. They're allowed to lend out a decent chunk of it, let's say 90%. This, by the way, is how banks make money. They lend out the money you deposit. So the bank lends out $90. Now some guy, Bill, has $90 that he's borrowed. Let's pretend he also puts it in another bank account because why the hell not? Now this bank has $90 and lends out 90% of that, so $81. They lend this to Alice. Alright, stop. Do you see what's going on? The Fed created $100, but right now Joe has $100, Bill has $90, and Alice has $81. So there's more money in circulation than was originally created. The Fed, or central banks in general, are not the only ones capable of creating money. Individual banks can also create money by lending. More specifically, if you follow the logic from above, the original $100 will eventually turn into $1,000. This is called the money multiplier. It's also why there's different measures of how much money is out there in the economy. The monetary base being what the central bank creates, whereas M2 is the multiplied money supply. So yeah, this logic says that the Fed can decide how much money to print and then you'll have banks multiplied by some constant. Alas, this is complete bull. Mostly because the Fed doesn't decide how much money to print, and because there is no stable money multiplier. Also, disclaimer, the economics textbooks are wrong not because of some conspiracy, but because the logic above is easier to teach. It's also why I explain it. It's a good starting point for eventually learning how money creation actually works. Speaking of which, enter endogenous money creation. The central bank does not choose how much money to print. It instead sets interest rates. More specifically, it sets the discount rate, the rate at which it lends money to commercial banks. Commercial banks can then basically give out as many loans as they want. No, really. Bank of America could wake up tomorrow and decide to lend you $1 trillion and poof, that money would suddenly appear in the economy out of nowhere. But they don't do that. Not because they can't, but because it's not profitable. Suppose they do really lend you $1 trillion. Now you have $1 trillion on your Bank of America account. Not knowing what to do with so much money, you decide to buy Greenland from the Prime Minister of Denmark. He tells you it'll cost 500 billion. You're like, huh, that's nothing, and sign on the dotted line. But now it's time for Bank of America to give 500 billion to Denmark, but they don't have 500 billion just laying around. Shit. So they take out a loan from the central bank to cover their ass. But the central bank charges them a really high interest rate and Bank of America goes under. Poof. Also, since a huge bank collapsed, the rest of the economy goes to shit and you get another Great Depression. Whoops. So yeah, banks don't lend out infinite amounts for the simple reason that they can't cover that much money if need be. No, really. Consider that Canada has had no reserve requirements for their banks for a while now, but their banking system hasn't collapsed because having your company collapse is unprofitable? Okay, so back to money creation. Broad money, M2, or multiplied money, is created when you go to a bank and take out a loan. It appears out of thin air. Then the bank goes to the Fed to borrow money and cover themselves. This determines the monetary base. The Fed does not decide how much money they'll print. They instead set the price of credit, i.e. interest rates. More specifically, the interest rates that banks will have to pay. This then affects the interest rates that banks will charge you. You then decide how much money to borrow and create, and banks will decide how much they need to borrow and have the central bank create. So yeah, that's pretty much it. Oh, but also, this isn't completely accurate because sometimes interest rates go down to 0% and the central bank isn't satisfied with how much money is being created and they resort to quantitative easing, which means they basically yell, "Let me drive," and start printing money themselves again. But that's a video for another time.